to sell, people just hold their holdings back, and or maybe if the demand is high, you cannot pay more. If there is a shortage, the rule is that you pay more, but since it is fixed, you cannot pay more, so currency is short. And if I want to pay, for my machinery, and I need to buy dollars, it maybe, or I need to buy in other currency yuan, so it take me like 1 month or maybe 2 months to buy back the yuan, because whenever I try to buy, the hype created, shortage created, and price goes up above 1%, and what happened? I cannot buy because operation is that it is fixed. Above 1%, the transaction is suspended. So then after that, they announced Smithsonian agreement, and they said, okay, you can fluctuate 2.25%. Just relaxation between 1% above or less to 2.25%. Here we go. So then we have the third one, which is floating exchange rate system, which is widely traded currencies are allowed to fluctuate according to the market forces. So it means essentially they have broke this boundary as well. So there is no government intervention. They just privatize that one. Okay. So if you need dollars, if you need yen, you create demand, price start rising. So up to the point you have the willingness and ability to buy, that's it. The price still goes up. So you have no control over there. So the foreign exchange transactions, so that was just a history of foreign exchange, how it is evolved, and the floating market concept, that's what we see today in today's term, right? But you still can ask question, why then $1 is still equal to 7 yuan? So then government has no control over this. There's a free floating market over there, but government can control with the mechanism of demand and supply. So recall your discussion. I think it's a macroeconomic discussion with the monetary policy, the intervention of central bank. Okay, maybe we have some kind of stuff here, so we will talk about that, but just going to give you the idea. Even though the government is not fixing the exchange rate, but you can manage this exchange rate through the use of demand and supply. How? So if you see that $1 is not equal to 7, so what you start doing, it means supply of yuan is increasing, so the value of yuan decreasing. So what happened? The governments buy back its yuan, or buy back or suck the yuan from the economy and save it with the central bank. And if you see that, the demand of yuan is so rising that the value of the yen is start rising, so they just throw the yuan into the market. In that case, the value of yuan start decreasing. So this is just a monetary policy. So governments through other means can interfere the market through the mechanism of the supply and demand, and can maintain the exchange rate. We also talked about in our first lecture in which we talked about that, okay, well, the trade deficit can a country without the intervention of government can do this kind of stuff. Then we talked about over there, yes, we can do that. If the government wants to increase or decrease its exports or imports, it do this kind of stuff. So when it do this kind of stuff, also initially they are playing with the exchange rate. So foreign exchange transactions, there are transactions in the market. It happens through over-the-counter as well. Over-the-counter means it is a specialized network which is designed for basically customized, transactions. So there is no standard transaction. If you need $1,000, you can find out $1,000, $1 billion, $1 billion, $250, $250. $1,035, you can also get this code, right? So there is no standardization. So these are specialized telecommunication networks where companies normally exchange one currency for another. And the over-the-counter market can also be offered by banks and some other institution. It can be customized as well, right? This is not standardized. So just going to give you the example. So let me share blackboard or whiteboard with you. Here we go. So in over-the-counter markets, over-the-counter markets, we also call this OTC markets. What essentially you are doing, if you need come on, about $1,005,000, you can go to the bank and ask the exchange rate. He can give you the 1,000. If you need $250, you can get it. Even companies can get it, individual can get it, whatsoever, right? But the standardized, this is customized, and this is standardized. Why I cannot write? Standardized mean you can receive the funding, or you can exchange the transaction in terms of some standardization. For example, you can trade in $1,000. So if you need $1,005, right, you can trade $100,000 and you have 10 transactions. You can have 10 transactions to get 1 million, right? But if you still need $5, you cannot buy the $5 unless you will buy another $1,000. So either you need to forget this $5, or either you will ended up buying $1.1 billion. It's standardized contracts, right? What if a person wants $400,000? So they just purchase transactions, or they do transaction 4 times, right? So in customized, you can also get 250,000, but in standardized markets, you cannot get 250,000 because one transaction is worth of 1,000. Either you buy 300,000, or either you buy 200,000 from the market and 50,000 from over-the-counter market. So this is the difference between standardized and the customized. Okay, back to our slides. So foreign exchange dealers, you can also wait, I cannot. Okay, so you can also basically uh, conduct transaction through foreign exchange dealers. So there are many, small businesses or big dealers companies like Western Union, Gram, yeah, Telegram as well. And then we have different kind of big companies who deals with this kind of stuff. Also, nowadays the banks are offering different kind of debit cards. You can convert your, like Visa, Mastercard, or the Chinese has also their network. I just forgot their network. Yeah, I just forgot. I will tell you later. So you can also go to different ATMs. You can, even though you have the yuan balance, but you can take out from those ATMs dollars, right? So this also facilitates the international flow of funds. The third one is a foreign exchange transaction for immediate exchange. We call this spot market. So spot market. So spot market, it is a market where you can have transaction on immediate basis. So normally, this over-the-counter market takes some time. If you need $1 million, you ask the bank, then I need $1 million. Bank will say, okay, give me 2 or 3 days, or maybe 5 days, or maybe 5 hours, right? Or 1 hour, 2 hours if they have, if the money is small. Foreign exchange dealer also need to arrange, right? If they have their, with them the dollars, they will give you immediately. But if they don't have, they will arrange for you, and it takes time. But a spot market is that market in which everything is available at the spot, right? Which has some immediate exchange. That's it, right? Immediate exchange. So the exchange rate in spot market is called spot rate. So if I want to buy $1 million right now, what will be the exchange rate? Don't give me 2 or 3 days prior. In that case, you will be conducting foreign exchange dealers or maybe over-the-counter market. But right now, what is the value if right now if the dollar is $1 is equal to 7 yuan. So if you want to buy $100,000, you just give him 700,000 yuan and you get $100,000. That's it at the spot, right? So the trading between banks occur at interbank rates or interbank market. So this is a special kind of, you can say, foreign exchange that only happens between the banks, because banking transactions are not in 100,000, they are in millions, sometimes 100 million, 200 million. So this is sometimes, the rate is a little bit lower. Why? Because quantity is huge. So that concept, which is right now in the market, that if you buy in bulks, the price is reduced. So, but that bulk is only available to the banks. That's it, right? So interbank rate, it's all also published on their websites as well. So also you can find out, if you can tune up different business news, you will find out over there. There is chart. You can just see that, okay, what is the rate of dollar right now? What is the rate of yen? What is the rate of pound, euro, right? So in that one, mostly that is the interbank rate. And some channels or some dealers, they also publish the open market rate as well. So there are different sites as well, like exchange rate sites, forex site, right? These kind of stuff. They also post the interbank rate, the spot rate as well, open market rate as well. Open market rate, which is spot rate, which is if you just go to the market and exchange the dollar against any currency, you can exchange at this rate. That's it. So this is called spot rate. Any question? Fabian, Jenlove, Marilyn, Not, Ping Ping, Kathleen, Crystal.
I actually have one question.
Sure.
Is spot rate, like exchange rate that is done in spot market, spot rate is different from exchange rate, or is it same?
This is a special condition, right? It
Yeah.
is exchange rate. Spot rate is the exchange rate, but we name it spot rate. Why? Because you are exchanging right now, immediate basis. So we call that exchange rate spot rate, right?
Okay, so it is same, but it's just done immediately.
Immediately.
Okay.
So all these interbank rate is also exchange rate,